Real estate or buying a home help with taxes? Great question. Watch this video. Hi, I'm Amol Heda with Keller Williams Bay Area Estates and author of Thriving Through Ownership. In my book, I call buying real estate as putting you on a catapult to build wealth. And this happens in many ways than just one. It's not just that the appreciation puts a lot of money in your pocket. It's the appreciation. It's a lot of different types of tax savings. And you are forced to pay the down payment, and each month you're supposed to pay the principal part of your mortgage. So, real estate helps you build wealth in many ways, and because it's that combination, you get onto a very swift and steep wealth building trajectory. So, I'm not going to talk about the appreciation because we all know about it, and we are not going to talk about the principal that you pay because it's just writing a check from this pocket and putting it into another. So, we are not going to talk about these two. The big thing is the tax benefits coming from real estate. And for full disclosure, I am not a tax consultant. Everyone's situation is different. That is why there are books and pages and volumes of tax related material. And you can see a lot of right and wrong material online. The best place or the person that will be able to help you is your tax advisor. So, all that I'm discussing here are ideas that you can take and work closely with your tax advisor to incorporate into your financial and tax planning. Cool? So, that out of the way, let's start talking about the tax benefits that you can look for. So, the first and foremost, when you buy a home, you can get a deduction in the whatever interest you pay on the mortgage for the first $750,000 can be deducted from your income. That's called as mortgage interest deduction. And guess what? We think with the interest rates that have gone up so high, the market should have collapsed or tanked. No, that's not happening, because what happened is the interest rates were at the bottom, like 2% for about 9 months. And from there, these interest rates have jumped to almost 7%. But guess what happened along with that? For the first $750,000, the interest rate at 2% was $15,000 only, which was much less than the standard deduction for a married filing jointly couple. So for them, the standard deduction was almost $29,000. So did they benefit from tax breaks? From the interest deduction? No. Even though they itemized, the interest that they were paying was only $15,000, and the property tax deduction is now limited to a max of $10,000. So if you look at it, they were getting a deduction of only $25,000 when the standard deduction is $29,000. Now, with interest rates say at 6%, that same number becomes $56,000, and property tax deduction is $10,000. So 56 plus 10 is 66. Subtract that from your income, you're taking home $25,000 over and above the standard deduction. So you're saving $2,000 in taxes. Go look at your own individual situation, because if you are married, it applies differently. If you're single, it applies differently. Even the standard deduction numbers are different for married versus single and how you file your taxes. So that's all. So mortgage interest deduction and property taxes, those can be written off. Now let's talk about investment properties. So when you buy a property as an investment, you have income coming from rent, coming from say parking lots, parking space that you might rent, and from the laundry or whatever else that might be there on the property. Say it's a furnished property, you get rent for the furniture. Or you're doing Airbnb, you get Airbnb rent and things like that. But your expenses are your interest, property taxes, HOA if there is one, any maintenance, any management fee, insurance, and depreciation. So all of this is subtracted from your rental income. Now guess what? You are barely paying any taxes, because even though you are making all this money, that depreciation is the notional non-real expense number hides your income from taxes for quite some time. But remember, when you sell the property, you have to pay for the portion of the depreciation that you claimed, you have to pay the same level of taxes as on your earned income. So there is that play too. But just imagine that today you can enjoy more cash by using these things. Next, when you buy a home as a married filing jointly, at this point in time, we can take a capital gains exemption of $500,000 if it is married filing jointly. If you're single, you can take the gain, exclude the gain of $250,000. Now, can you say in the Bay Area, a typical house is $2 million, 5% appreciation per year. Each year that will appreciate by about $100,000. In 5 years, you got that gain. Even if you hold the house for about 6 years, even after all the closing costs, commissions and everything, you can put that $500,000 clean in your pocket, no taxes on it. That's another way you can save taxes. So these are just a few ideas. If you work with your attorneys, with your estate planners, with your financial planner, together with agents like me who understand the tax impacts and how to use these to make them work for you and work with your professionals, financial professionals, you will be able to pocket much more. If you think this advice is helpful, please let me know. If you want specific information on specific rules around saving taxes, please comment below or reach out to me and I can help. Do you think this was helpful? Please share it with someone who might like it. And if you have any questions, feel free to comment below. Thanks for your time. Thanks for watching. Bye.